So I realize people will gradually be joining over the next couple of minutes, but welcome to our session. My name's James Wallace. I'm basically going to be your host for the next 30 minutes, and I'm joined by my lovely co-host Mark, who is an award-winning behavioral economist
Get
that
that
we
right.
work quite that we work quite closely with. So, a couple of housekeeping rules to start with. The session is being recorded, mainly in fairness, I think, to be used against me in evidence at a sort of future team debrief. But after the 30 minutes, we're very happy to stay behind, answer any questions that people may have. Just ask your questions in the chat box. I realize some of you are very busy, so feel free to drop off after the 30 minutes. Now, the purpose of the session today is really to get under the bonnet in understanding the value, the real value of advice, and why we as individuals often fail to achieve our longer term financial plans. Now, my passion in this area really grew out of being a pensions lawyer for just over a decade, and I've been lucky enough over the last few years to help so many people work towards attaining the life that they actually want. And my background provides me with this sort of understanding of the demands, the pressures, and the life, especially those in the legal and city professions, and have used to help over the last few years. So now I'm going to just get down to business and start off for a minute explaining for us what financial planning with purpose actually is. Now, for me, it starts with a visit to Harvard Business School, because believe it or not, I realize Mark doesn't know this, but I was considering going there once upon a time. But what actually stuck with me was the question that they ask all graduates to answer. And it's, what is it that you want to do with your one wild and precious life? Now, we all have one life. I might be able to minimize some of your taxes, but I certainly can't do that with death. But the issue that many people have had is that they haven't actually stopped to think about what life actually looks like. So, what is it that you want for your future? What are your hopes, your dreams, your aspirations? And then, effectively, once we understand what motivates you, we can effectively devise that plan to make things possible. And that means building in flexibility. It means everyone going through transitions. And effectively, it means creating a purpose and a vision of what you're trying to achieve. Now, this session is really designed to make you think about the whole area of financial planning and advice and the benefits of that, because for most people, they think it's just about picking an investment. Well, anyone can do that. You can go onto an app, you can click a few buttons, and you can invest your money. But really, the questions that we all ask or should be asking is, well, what is it for? How much do you need? What assets? When to buy and sell? What risk? What time frame? At what point should you panic? What's the cost? The tax wrappers? How do you minimize tax? All of what is the actual purpose. So for us, this session is going to explore the things to think about and the behaviors involved in finance. And that really is where Mark comes in. And I'm going to pass over to him just to give a couple of minutes overview on actually what behavioral economics is. And then we're going to get into a lovely question and answer where I'm going to ask him some, well, I think quite fun questions, but we'll see. And so as you go through the session, do feel free just to add your questions into the chat box, and then we can deal with them, as I said, at the end, after we've had the sort of 30-minute chat. Feel free to stay behind. So, Mark, over to you for a couple of minutes.
Well, you want me to explain what behavioural economics actually is?
Yeah, I do.
A definition.
You've only got a couple of minutes to do it.
Well, it's very. Everybody probably knows what an economist is. Our lives have been dominated by economists, and probably most people have done some form of economics at school. But the fundamental around economics is the belief that we all act rationally. The definition of economic rationality is that we all act to maximise our utility. That's normally measured in the form of money. It can be measured in the form of time and status. But everything we do to maximise this utility. It's all very simple. It all follows mathematic laws. It can all be drawn on a graph. And the fact is, we're just not rational people. We're full of emotions. We have biases. We have things that take us off track. We react instinctively to things. And it's those very emotions that have got us to the top of, if you like, the top of the food chain as a species. And it's helped us, they've helped us a lot in our evolution, but they really do not, those same biases and heuristics and reactions do not help us make good decisions in financial decisions in the 21st century. So behavioral economics is really financial psychology.
Great. But why should people actually care, though, about taking a sort of purpose-based approach? Why is that important in your view?
So we've been obviously doing huge amounts of studies, with the university. Obviously, we've been involved in financial services myself for many years. And it's interesting what you say about the right investments, for example. Some of the best fund managers that we know, the biggest frustration that they've had when they've come to retire is the fact that they've returned they've made fantastic returns for their clients. But when they look at how long their clients were invested and the fact that they kept dipping in and out, it absolutely reduced the returns that they were going to get. And it's because people don't frame things over the right time frame. So as you said, financial planning with purpose is all about understanding what your journey looks like and really understanding the fundamentals, those intrinsic motivations behind what it is you're trying to do. And we did this study with cars. It was very interesting. We were asking people, how happy are you driving your car? And there was a direct correlation between how happy people reported they were driving their car and the value of the car. So the more expensive the car, the happier they were driving it, because they were thinking about their whole experience about owning and driving this car. When we changed the question to how happy were you driving your car yesterday, the correlation completely disappeared, because people weren't thinking about the whole journey and the whole experience. They were thinking about the fact they got stuck in traffic yesterday. They got, or kids were screaming at them from the back seat or whatever. And so financial planning with purpose ensures that you are looking at the whole experience of your financial planning journey, rather than just what happened in the markets yesterday, which are completely irrelevant for your long-term, for the long-term purpose that you're trying to achieve.
And I quite like the car analogy, actually. I think it's very helpful. But in the world of financial planning, anyway, the thing that I come up against a lot is inertia, right? So it seems to be the key driver, and we know that we should be saving for the future, and we know we probably should have started earlier. But why do most people just not do that?
Well, if you've got £10 in front of you, you can always rather spend it on sweets or beer, can't you? I mean, it's as simple as that. So there's this present bias, and there's also, and there's also the fact that we're just simply not wired to behave that way, because we can always start tomorrow. It's something that we can always put off, but it goes right back. This present bias is a really very strong heuristic that we have. And if I said to you, if all the research shows, if I say to someone, look, do you want two, I've got two keys to safety deposit boxes here. You can have £200 now or £210 in a month. Nearly everyone goes, I'll have the £200 now. Interesting enough, if I say, right, if I rewrite the question and say, okay, you can have £200 in a year or £210 in a year and a month, people say, oh, well, I'll wait the extra month. But there's still only a month between now and in a month's time, and in a year and in a year and a month's time. So the rationality would say, a rational response would be the answers would both be the same, but our preferences actually reverse. And if we go right back to when we were hunter-gatherers and we went out to make a kill to bring back and feed the tribe, the worst thing that could happen is after we've made that kill, we lose it to another predator. So we have this massive present bias. And actually the misery of going back to the tribe with nothing is a lot more than the equivalent joy we would have of bringing back 2 kills. So we have loss aversion, we have present bias. These are great things to keep your tribe fed. but they're pretty appalling at trying to help you make financial decisions about your financial future.
That's really interesting, isn't it? The loss aversion side of things.
Loss aversion is, yeah. I mean, the pain of loss from the starting point of what we've already got. The pain of loss is far more intense than the pleasure of gain.
I think that's. I mean, in March we sort of witnessed the fastest drop, if you like, in stock markets in probably the shortest time horizon, I believe, since the crash of 29. And when I was reading articles around the time, the FT suggested that almost a quarter, 25% of people sold out near the bottom. And some have now come back to the table, fast forward a year when markets are actually not down 30%, but up 10% from that point. So effectively, what people seem to have done is crystallized a sort of 30% loss at that point. And I guess loss aversion comes into that. But what do you see as really driving that behavior? Because that is simply one of the worst things that you can do, and almost a quarter of people that were invested obviously did it.
Well, we're put into a stress situation. We often use the phrase, if you're standing in front of a bear trying to rationally calculate whether the blow of its paw is strong enough to kill you, you're already dead, aren't you? We have fight, we have flight, we have freeze. And what happened when those markets collapse? People just want to run away. They just want to stop. So what happens is when everything is the markets are racing ahead and all the headlines are positive, we all become risk takers. When the world's going to hell in a handcart and Robert Peston scared everyone the night before about, everything's going to be a disaster, we all become risk avoiders and we just want to get out of there. We just want it to stop. We just want it all to go away. And you're right, people who quite often who are self-invested, they are not able to resist these natural biases to jump in where everything is overpriced and to panic and get out where everything is at the bottom. And like you say, that is the worst decision those people could have possibly made, was not to stay invested. And having an advisor to help you understand how you're feeling and going, look, I know it's really painful. I know you just want it to stop, but stay invested. Those people, those advisors who held their clients' hands back in 2008, for example, and said, look, I know this is a really horrible feeling, but stay put. They have done more for the wealth of that individual and subsequent generations than actually any individual fund manager or any particular product that was recommended. It's the advisor who's saying, stay invested, stay in the game. That one decision on that one afternoon has made a huge difference to the wealth of those individuals.
I guess that is an important job in a way, as we're talking about for advisors, because it's not just about the investment, it's kind of about the purpose behind it, and that was what for me it's a big driver. Whereas if you can kind of point people to say, right, well, this is invested for this reason, for this purpose, and therefore you need to just ignore the noise. That's a sort of big driver that you're sort of encouraging a lot of people to do. It's basically, I think you used an analogy at one point to me of I think you were just sort of saying, oh, well, best thing to do is just tie you down, blindfold you, and then wake you up in 20 years time.
Yes.
But again, that depends whether the purpose of your investment is to invest in something for 5 years or invest for something for the longer term. But I guess this is where planning with purpose comes into it, because if you know you don't need the funds at that point, then you don't need to be worried about it, and peace of mind is a real driver, I believe, as well, in terms of the approach.
Reassurance is massive, but the purpose thing's really important, because I always say, if the first question, if you're going to a financial advisor and the first question is, how much have you got and where is it? I'd just find another advisor, because the conversation's all got to be about what it is that you're trying to achieve with your money. And it can be very, very different things for a lot of people. I was talking to a friend of mine recently, and they were saying, look, could you give us some advice on this money? And it was a reasonable amount of money, and of course it was, they're a very good potential client. But until I said, look, until you've had the conversation, as a family and with your partner about what it is you want to achieve, how can I help you? It can't be just about to make the money more and more and more, because that has implications for the levels of risk and things like that you want to take. And actually they went away, came back 2 weeks later, and his wife said, we would have never had that conversation unless you'd sent us away. And we really have thought about what it is we want to do over the next 10 years. And that's had a real implication on where we're going to put this money. So you have to have that conversation and really think about the purpose behind your investing.
Yeah, that's exactly right. It gives people the opportunity to think about what they really want. I had a client recently that actually, went away, decided actually both her and her husband were going to work 4 days a week because they didn't actually need the level of money in retirement that they were effectively saving towards, and it was more important to sort of spend time with the family now. That was great because they took
lockdowns
that
had a
decision.
huge impact on that as well. Actually, it's very
Exactly.
the research we're doing about people have really changed what's important to them.
I guess one question I was going to sort of come on to was, so back in 2008, 2009, when I was still a sort of young law student, playing the market, I guess what a lot of people are doing over the last year, it was just after the crash. So obviously I thought I could make lots of money. I invested in 2 different stocks, and I can hear everyone screaming that it's the worst thing to do. And obviously, hindsight is a great thing. But 2 of the stocks that I effectively went into, one was RBS. We all know where that ended up. And then the other was Apple. And we know where that ended up. The difference is I got quite excited that I made a 20% gain on Apple and sold out. Whereas effectively, if I'd kept it in, I could now probably have bought a Ferrari. And then obviously RBS, I held on to for as long as I felt I could. And then it was just, no, I learned the better way. So I guess my sort of question is, can you kind of talk me through, I guess, the behavior that I was exhibiting at that point and what a lot of people are doing now in terms of sort of chasing returns? And over the last year, everyone's been sort of piling into the market. There's loads of new investors as well that have come on, especially with the sort of advent of platforms. But what sort of behaviors are driving or were driving my decision? And really, why should I have listened to you or wish I'd listened to you a decade or so ago?
Well, first of all, you really explain to people why they need a fund manager, because it's that ability to not get emotionally attached to any particular stock and not to anchor on your buying point. So with one of the, if you sold at a loss, what you've done is you've anchored completely on the price that you've purchased. So you know that anything you sell below that, you're effectively crystallizing a loss, which isn't something that you want to do. Fund manager would have obviously dealt with that situation in a very, very different way. But actually, sometimes the way to look at it is to say, right, okay, the value of that stock has fallen. Now let's imagine you never bought it. And let's imagine you weren't anchored to the price that you paid for it at all. And then someone said to you the following day, right, you've got a choice. You can have this money, which is the amount you could have sold them for, or you could have these shares. All the research shows is that people say, I'll have the money. Well, then why don't you sell them? Because that's exactly the same result that you would get. But we don't. We go, oh no, it'll recover. It'll get back to, it'll get back to its point. Interesting thing with Apple is you go back into the late 80s and Apple stock did collapse. So it's not a one-way journey with any of this. But this is really why good fund management is what you need behind it. That's your engine room, really.
And that's definitely the key. You can't it's investing with purpose, isn't it? There was the only purpose behind me picking those 2 stocks was I thought I would make some money.
Well, that is that investing or is it gambling?
I would say it's gambling.
I'll leave you to
definitely gambling. So I guess it's sometimes difficult. I see for potential clients to really understand the value of advisors, because in the past it has been all about the sort of investment that people take, and they get sort of hung up on that side of things. Now, I left a career in law to effectively get into this world because I know it does make a real difference, and you can help people over time. But Mark, you and your team kind of completed a report into the value um, of what long-term financial advice, proper financial advice, actually does and what it can achieve. Now, we both know that it is more than about investment, because I believe even you have your own financial advisor as well. You know, it is, we all have our own sort of behaviors and drivers and things, and why it's always helpful to have that sounding board.
Mm.
A bit like why you should never act as your own lawyer, I think is always the thing. You shouldn't really act as your own financial advisor. So can you kind of explain a little bit more around the sort of research that you did and the value side of things?
Yeah, I mean, we did. Can I actually? I've got a slide that would probably,
Oh
if
yeah,
I can share my screen here, if I can get this slide up, it will.
oh yeah,
So
I can see that now. Yep.
can you see that? So if I just show you quickly, so our advisor Delta work, we and it's been peer reviewed, so it's been properly researched. We looked at people that had advisors and people that were self-advised, and the difference that it made having an advisor was significant. But the areas in which people in which advisors made a difference, that may be quite surprising to some people. So we identified these three areas where taking advice really made a difference. It was how investments were held. It was the solution enhancement, so where your investments were, and then the behavioural coaching. So these were the three areas. So the how held were, is it in the right name? Now, even utilizing all your tax allowances, your partners, all the various tax allowances that you have that once gone are gone forever, that makes a big difference. Who's the actual owner of the asset? How do you use trusts? How do you make sure you've got the right beneficiaries getting the right money at the right time? That makes a difference. And also, obviously, the tax shelters that probably most people think, well, yeah, that's why you go to an advisor to make sure that you're utilizing all your tax shelters. Of course, that makes a difference. That makes a difference to the returns. Then there's a solution enhancement. David James Wealth is part of Quilter, which are a FTSE 250 business. That makes a big difference to the prices at which you can access solutions. So, there's an advantage there. There's the rebalancing. Again, it's this fact that you're not holding on to a stock. You're constantly rebalancing and making sure that your investment stays relevant to the risk profile you're prepared to take, the risk journey you're prepared to go on. And again, it moves things around the market based on what potentially is going on. And so the suitability stays relevant. You don't find that suddenly your portfolio is looking far riskier than you would ever want it to. And then the third thing was this behavioural coaching. And it was the behavioural coaching that actually made a huge difference. It was keeping people invested. It was making sure they were reassured at times where they maybe weren't feeling as confident. And it's the fact that also that you're constantly reminding them of what's coming up, what's available. Have you taken advantage of these allowances? Because if you don't by a certain date, they will have gone. Constantly helping clients to stay on that journey and constantly reminding them of the purpose behind their investing in the first place made a huge difference to the overall returns. Now, everybody's mileage is different, so depending on your personal circumstances, it will make the figures will be different for everybody.
Well, a year ago, it might have made a difference of 30% to someone.
Oh, in 2008, the market
It
collapsed by
depends.
51%, didn't it? And
Oh yeah, that was over
yeah,
like
but
18
look
years.
at the 10-year bull run that happened afterwards. Absolutely phenomenal.
But again, this is the key thing: is that for us as advisors, isn't it? You can't predict the future. That no one can sort of tell you accurately, and that's where it comes down to things like time in the market rather than actually trying to time it.
Yeah.
All of these side of things, which are hugely important.
Mm.
But actually, it's realizing that you and I don't have a crystal ball. Anyone who is guaranteeing you X amount of return, or we can do this on cryptocurrency, is going to go this way. And what was it? If you see it on the side of a bus, it's time to invest.
Yes, yes.
Oh.
If, if
I'm
your
just wondering
taxi
how it
driver's
gets.
giving you the tip, yeah,
I'm just wondering how it gets on the side of a bus. But that's really interesting. So in terms of the approach that you went with the advisor delta, it's really those kind of layerings, isn't it? And it's the behaviors on top. It's the sort of purpose behind it that holds everything together, isn't it? Because the purpose will determine whether the right thing might be to almost get X amount of tax relief into this pot or that pot, and it all just comes, it's all about tying it all together.
Yeah, that's just the mechanics. That's just stuff.
Exactly.
That's just, look, here are some tools that the government give you to help you leverage up the journey, if you like, but that's not the reason behind it.
Exactly.
And that's the difference.
Yeah, no, that's really helpful. Thanks very much. I guess in terms of, I'm going to finish off and just sort of run through the last couple of minutes, but please feel free to basically message in any questions that you've got. So if any of you want any questions answered, we'll sort of stay behind for the last 5-10 minutes afterwards. Happy to answer any questions that anyone's got. But for me, the sort of key takeaway point from this session is that it really is more than investment. It's about the purpose in your own individual life. And the goal and the aim of an advisor is to effectively help you achieve that over the long term. So it's about helping, as Mark said, on that journey, acting in clients' best interests when their own behaviors and biases get in the way of decision making. And it's in a way about getting you to that destination and reminding you constantly of the purpose, why you set out on that journey. And really, the question that you probably need to ask is, who do you actually want helping you on that journey? Now, it certainly doesn't have to be us. There's 25,000 advisors out there. I got into this industry because I love it. I've spent ages as a pensions lawyer and then realized this was just my passion. But if you do want to actually have a chat with any of us in the team, then feel free. All our details are on our website. We aren't lawyers. We're not going to charge you by the hour. And in fact, we don't charge at all. The first meeting's on us. And effectively, we don't have a perfect client. The questions that we ask are, can we actually help you? Can we add value? And then do we actually want to work together for the long term? And that's really it. So thanks very much for joining with us this morning. And thanks to Mark as well for being here on the panel.